Good afternoon. It's Marius Botha speaking. Welcome to the second session of the PCE training. Just before I start, I thought I'll just mention the following. I've been presenting on the web for many years, especially for one company it was. And I normally started, in most cases, my presentation by saying, good morning from a wet and cold Cape Town. It's not the case today. It's still dry and it's still hot. However, we're having apparently some rain this weekend in the catchment areas. I hold thumbs for that. I hold thumbs for you for next week. If it rains this weekend, I'll hold both my thumbs for you for next weekend for passing the exam. So continue to work hard and you will eventually get there. What I'm going to talk about today, you see the agenda on the slide, case study with questions and answers. It's a simple little case study that I've used before. I've just updated it just to take you through the motion to discuss. Then I've been asked to, by way of an email, to send more than one person the accrual formula for life assurance, which I referred to during the FBI's face-to-face sessions that we did throughout the country. I've included that. I don't think it's for the exam that important, but it has been asked. I received emails asking to have another look at the Section 11F deduction in respect of contributions to pension fund, provident fund, and retirement annuity funds. I've included a new one that I've done on a spreadsheet at the back. I'll talk you through that. And then also refer to, I must talk just briefly again about Section 10C. It is a topic that Talani, together with taxation of lump sum benefits, said that students did not do too well in examinations in respect of that. Now, apart from what I'm doing on these seminars and what I've done on the face-to-face sessions, remember those guidelines. Don't forget to read all of those cases and all of the things that Lalani referred to, the FBI's code of conduct, those determinations that she mentioned to you, and a number of other things that's on the, when I say she mentioned to you, that's why when she referred simply to the guidelines that the FBI have provided to you. Let's go straight into the case study. Michael and Susan are married out of community of property subject to accrual. Now, I don't need to, I'm sure, to explain that. You all know what the accrual system is. In the antenuptial contract, they both declare their asset values at date of marriage to be zero. A little bit different from others that you do quite often, or mostly they give you the opening value and they give you the consumer price index so that you can do the consumer adjusted beginning value. In this case, it's zero, so there's nothing to update. Michael is 57 years old and Susan is 55. Michael has two children from a previous marriage, who's George, 27, and Esther, who's 24. Both are employed and self-supporting. Susan has a daughter, Jennifer, 14, from her previous marriage. Her first husband died 4 years before she got married to Michael in 2013. Michael's first wife died in 2011. She bequeathed the residue of her estate to him, except for insurance policies of 3 million rand to her children, so that her net estate is 3 million rand. I highlighted that because when I used this example in a previous occasion, somebody sent me a message and asked me about that. Now, in this case, we're going to look at the Section 4A abatement deduction when we do the estate duty calculation. And obviously, because Michael has got a predeceased spouse, we've got to take that into account. If she bequeathed her entire estate to him, except for insurance policies that went to her children, her net estate would have been 3 million rand, which means that that 500,000 rand of that has not been used. Michael is employed with Acme Distributors, a large company that have branches throughout South Africa. He also owns 50% of the shares in Michael Importers Pty Limited, a company that imports Acme's goods from Europe. His brother-in-law and co-shareholder John manages Michael Importers. John is 42 years old. He owns 48% of the shares, and Michael owns the other 2%. I'm just going to change the slide. I need to do that. Yes, sorry about that. Here we go. Michael promised George that he will bequeath his 50% in the business to him. Michael only receives an annual dividend distribution from the Michael importers. He gets no salary from the company. Most of the profits are invested back into the company. Michael is happy with that, as he wants the business to grow as much as possible so that George can have a good business to take over. George and John have a very good relationship. The company has showed very good growth since it was formed 10 years ago. Michael wants to retire from his employment in order to join Michael Importers on a full-time basis. He does not want to do that unless his retirement capital is sufficient to provide them with the income that they require for their retirement. The rules of his Provident Fund says that he can retire from that without penalty at any time after attaining the age of 55. His assets and liabilities are the following. Market value at the right, base cost at the left. I'm not going to read all of the figures. Primary residence, share portfolio, shares in foreign companies, 50% in Michael Importers, that's his business interest, portfolio of unit trusts, cash investments, motor car, and then apartment, a flat that he has in Kenilworth in Cape Town, so that the total value of his assets is 9.91 million. I said that at the live sessions that we had throughout the country, that as a bit of an exam tip, it's not something great, but it'll save you some time. If you have to do an estate duty calculation here in respect of Michael, should he die first, all of this here that you can see will form part of his estate for estate duty purposes. Every single asset here, as I mark them, you will see will be included in his estate. So when you do the estate duty calculation, you don't have to list all of that. It takes time to write down the name of all the assets. You can say total value of the assets as given, and then you can just proceed and then do the other things that you need to do. Right. Liabilities of Michael, he's got a bond, a loan on the primary residence of 450,000, a car loan of 110,107, and the total of his liabilities 561,07. Some notes: the original car loan was 300,000 and the monthly installment 960. The interest rate 10% and the balance of the loan after 2 years is 110,107. Now, I'm not discussing this year in this case study, but as I say, I use this as a base to speak about other things as well. If you ever get something like that in the exam, you will probably agree with me that if they ask you to do an investment portfolio for the person, you will consider, or say to the client, he must consider repaying those loans because the interest rate at 10% and the housing loan, the second one at 9.5%, is quite high. It would be better to repay them. He's not going to get a rate of interest that's going to exceed that before, that plus the tax. Right, the following are assumed regarding the administration of his estate should he die. The administration fees, executor's fee excluded 30,000. I received an email last night from somebody, I can't recall the name, there was quite a few. And the one person asked me in the case study that we did earlier this week, why did I not include the master's fees, which is now 7,000 rand? And the reason for that is simply the administration fees here that are given, the 30,000 rand, is exactly that plus the valuation fees plus all of the other things. So that 30,000 rand would include the master's fee, but it does not include the executor's fee. So in this case study, you've got to do the executor's fees, and the only other administration fee that you have is the 30,000. If, however, in the exam they don't say that, if they simply say to you, do the executor's fees, or they say to you the administration fees in respect of valuation of property for CGT and estate duty purposes was so much, and then they say you must do the executor's fee, you must also then do the master's fee, and make sure that you have that sliding scale with you. The funeral cost here is assumed to be 20,000 rand. Michael has the following life assurance policies on his life. First policy, it's a pure risk policy with no cash or surrender value. It's got a death claim value of 2.5 million rand, and there is no beneficiary that is nominated. About that, it will be taken into account for the purposes of the accrual claim, and also, of course, it will be deemed to be property in his estate. And because of the fact that it is payable to his estate, we're going to have to include that in the cash flow at the end as cash available on death. Policy B, also a pure risk policy. His wife is nominated as beneficiary, and the death claim value is 1.4. How are we going to treat that? It's deemed to be property in Michael's estate because it is on his life. It's going to be payable to Susan, so section 4Q will negate it. You'll deduct it so that none of it is dutiable. And of course, you're not going to take it into account for the accrual claim purposes, and you're also not going to take it into account for the purpose of the estate's cash flow. Then the third one, a pure risk policy. He nominated his children Esther and George as beneficiaries, and of course the death claim value there, 900,000. How do you treat that? Deemed to be property. No executor's fees on it. It's not payable to the estate, and you don't take it into account for estate duty purposes. Sorry, you don't take it into account. Let me repeat that. For the purposes of the accrual claim, you also don't take it into account then for the cash liquidity at the end, but you do take it into account as assets that will be available for the children's maintenance education later. Susan, she's got a portfolio of unit trust. There's a note below which I'll read now. Cash investments, motor car, furniture and household effects, jewelry, total assets 3.79 million. Her liabilities, credit card, only total liabilities 40,000 rand. Now, the notes on her assets, a portfolio of unit trusts were bought by Susan with an amount of 1870 that was donated to her by Michael during their marriage. The main reason why this was done is that Michael thought it'd be a good idea if she invests the money in an interest-bearing investment so that she could be taxed at a lower rate of tax than what he would have had to pay. So firstly, that 1.870, when we do the accrual claim, must be excluded both from the estate of the husband and the wife because it was donated during the marriage. And then, of course, what we have is the matter about tax. The fact that he made that donation to try and not pay tax on those assets if he invested in his estate so that she could get it will simply mean that under section 7.2, the interest that she receives will be deemed to be his. After the donation, Susan was advised by her financial advisor to invest the money in a portfolio of unit trust. It is a pure equity unit trust, and she will receive a before-tax dividend of 41,400 for the current year. The units have not increased in value since they were acquired by Susan. That is not, the facts were not written like that so that you should not ask me, but what if they have? If they were the same units that have increased, we would still exclude them because it's also assets obtained as a result of it. Sorry, we would still exclude it. We exclude the original amount or the original units plus any units that were obtained out of the proceeds that was donated, in other words, the investment. The important thing here, the point that I really wanted to make, is that because of the fact that there is no income that is not exempt, there will be no tax in her husband's hands, and the dividend she will be taxed on. So section 7.2 will not pull the dividend tax into the husband's tax, but whoever pays the dividend, it's the same rate. Michael's current income from his employer consists of an annual salary of 900,000, an annual bonus of 70,000, medical scheme contributions by his employer, 2,200 a month. That, of course, is a fringe benefit of 26,400 in his hands for tax. His employer also pays the premiums in respect of 2 unapproved group life policies, which are for Michael's benefit. These policies are a pure risk policy with life cover of 850. The policy will pay to his surviving spouse in the event of his death. The annual premium payable by the employer is 12,000 rand. Now, just to state that again, I think we did speak about it. The premium paid by the by the company in this case would be tax deductible in the hands of the company under Section 11W1 because it's a policy for the benefit of an employee or a director. The amount that is so paid will be included in gross income. We'll get to that a bit later of the employee, and he will effectively be taxed on it. And then an income replacement policy, the annual premium paid by his employer is 18,000 rand per annum. That also is tax deductible in the employer's hands, also 11W1, but of course the position is for the employee. He will be taxed on it, but he will get the benefits tax-free. Michael pays a further 1,500 per month to the medical scheme. He and his wife and Jennifer are the only members. The qualifying medical expenses that they could not recover from the fund was 100,000 rand. Their retirement provision. Michael is a member of his employer's Provident Fund. The current value of his retirement interest in the fund is 5.4 million rand. In terms of an unapproved group life scheme that is part, sorry, I beg your pardon, let me read that again. In terms of an approved group life scheme that is part of the fund will pay an amount equal to twice his annual salary in the event of his death. This is in addition to the investment value of his interest in the fund as at the date of his death. His employer contributes 10% of his salary to the Provident Fund. Michael does not contribute to the fund. He retired from a retirement annuity fund after he turned 55 years old. He was not happy with the fund performance and made the decision to retire and transfer the full benefit to a living annuity. He used the annual drawdown income to pay his son's university education. The son has now completed his studies. The current value of the assets in the living annuity is 1.189 million. He takes a drawdown amount of 2.5% per month. His wife's daughter, Jennifer, is nominated as beneficiary to the living annuity. He has not received any retirement fund lump sum benefits in the past. He would like to, and this is what he wants for retirement, to receive an income of 70% of his current salary if he is to retire today. He wants this income to be paid until he and his wife reach the age of 77 years. It must increase annually at the rate of inflation, 6%. His Provident Fund benefits, living annuity, and share portfolio must be taken into account as retirement capital, but not these assets for retirement purposes. Also, if he takes early retirement to join Michael Importers, he wants to have assets that are not needed for his retirement in case the business needs further funding. He will repay the outstanding balance of his bond when he retires. And there's Michael's monthly cash flow. You can see there that his salary is 75,000 rand per month. Living annuity drawdown is 2.5% of that divided by 12,247.7. And then there's the other expenses. I don't want to mention all of them. Perhaps you can look at the loan repayment, housing loan, that we can improve his cash flow there by repaying the housing loan, and at the same time he will do better because the rate on that is quite high. Then qualifying medical expenditure, I've just assumed here for the purpose of the exercise that he's been paying that over a monthly period of 12 months and that he's still paying on it. Existing life assurance, 1,200, monthly installment on the car, that we can also do away with by getting him to, if he's got the cash, repay it and then improve his cash flow and of course his return on that money if he invests it elsewhere. And then at this point, no income tax, because what we're going to do, and that's the purpose of this one, it's a bit of cash management or money management. We're going to calculate the tax in one of the questions, and then we're going to take that tax and divide it by 12 so that we can then complete the cash flow and also update the cash flow with maybe other recommendations that we make. Notes to the monthly cash flow. Investment income is not included in the above cash flow, as it is all reinvested and not used to pay their monthly expenses. His annual bonus is excluded from the above cash flow as Michael uses it for their annual overseas holiday. Michael was not sure of the amount of income tax which he's liable for the year, so therefore that's why it was left out of the cash flow. And Michael received the following investment income for the year: dividends from the Pure Equity Unit Trust Fund, 30,450, local dividends from the shares on the JSE, 26,400, foreign dividends 13,600, and interest on the cash investment at 6% assumed 21,000. Michael's last will and testament, and this is something I must just stress again in the examination, make sure that you take that into account. I have myself often done presentations, tried to do answers to old questions, and you read all of the facts, you concentrate so hard on the assets that you forget that in fact the way in which his estate is bequeathed to his family affects the estate duty, affects the cash flow, affects a hell of a lot of things. So read that, highlight it, take it into account. His last will and testament, in terms of that, he bequeaths his apartment in Kenilworth to his daughter Esther. He bequeaths a cash legacy of 2 million rand and the shares in Michael Importers to his son George. He leaves the residue of his estate to his spouse. Now, this is one of those estates I didn't have the opportunity of really mentioning that during the sessions we did down the country, because you will remember the one we did when I spoke to you in those sessions was one where the residue was not bequeathed to the surviving spouse. In this one, the residue is bequeathed to the surviving spouse. So what I can say to you here already now is the following: that the value of the apartment in Kenilworth, plus the cash legacy of 2 million rand, plus the shares in Importers, plus the life assurance policies, which is on a different slide, that does not go to the surviving spouse, but that goes to the children. That if we total that, if we take the value of the apartment, the 2 million rand added to that, the value of the shares in Michael Importers, and the value of the policies that go to the children, we get a value. And the position is that his estate will only be liable to pay estate duty on those property assets and deemed property that does not accrue to his surviving spouse. The only possible estate duty that he can pay, I always say that, is in a case like this, is the estate duty on those assets that do not go to the surviving spouse. We can add that, and I will do so. You will see later on. I do that and make a comparison, not in the exam, but when you practice this, see if you can do it. It makes you do the thing more correctly. But obviously in the exam, I know there's a time limit. First one, calculate the amount of capital gains tax that will be payable by Michael should he die today. Now, it's a very simple calculation. But before I say that, I've had a number of, when I say a number, probably 4 or 5 people asking about the deductibility of capital gains tax for the purpose of calculating the accrual. Now, the answer is yes, you must take it into account. I can't see how you cannot take it into account. In other words, you need to have the figure. I've calculated it here. We'll go through it now at 68,400. When we're going to do the accrual claim, we're going to take 68,400 as a liability of the husband when the marriage is dissolved on his death. We're also going to take that as an estate duty liability. What I often, however, do in practice, or in most cases, is just leave it out of the accrual. Because what you don't know, but in the exam, don't leave it out. Do it and show it in both those 2 instances. I'm just saying that I like to leave it out, especially in questions, and then go back and say to the students, as I've done with that case study that we've discussed the other day when I went around the country, is to first see the way in which the estate is dissolved as to what is given to the wife in terms of the accrual claim, what rolls over, how much cash is there, are there more assets to be needed to be sold, is the wife perhaps, according to an agreement between the 2 of them, happy to take the assets and not to take it as a cash claim. first establish that, which in a practical case, you will know that the first husband is dead. We know exactly what's going to happen. In practice, you don't have that historical background that you know that it has happened. So I always leave it out of account, then I make recommendations, and then I go back and I change it. And I say, I change it for this reason because this is what's going to happen. But for the exam purposes, please show it. I calculate it as I've done here. Show it in the estate duty calculation. Use it also in your capital gains tax calculation. Perhaps what you can say in your recommendations is that, of course, once you've seen what happens to the estate, you can say that this and this will have the effect of lowering the capital gains tax, and that will affect both the estate duty and also the accrual plan. Okay, let's look at this here. This is simple. There's nothing to explain. There's no massive asset. I've looked at some of the old papers that were sent out. I also discovered 3 of them, older ones that was sent to me 2013 and 14. And I see there that they had on more than one occasion, there was an asset that was a pre-valuation date asset. Now, you know, I know nothing about the exam. I don't know whether it's a possibility or not, but I would suggest that at least go and have a look at such a calculation so that if one comes up, you can do it. In other words, an asset that was acquired prior to the 1st of March of 2001, perhaps in respect of which there were improvements made after that date, and then calculate the value of the base cost. And you know there's the 3 possibilities that the taxpayer can choose from, but you must choose the highest one, and also part of that is the time apportionment base cost. Visit such a, don't spend a lot of time on it, but you never know. Remember, the only guideline that we have is, if I remember from the guidelines given by the FBI, that you must know all the estate planning calculations. That's very wide. It could even include something like that, but let's hope not. Yeah, we have very simple market value base cost of Michael's Importers, capital gain 450, and then the apartment in Kenilworth 1480 minus 1250, 230,000 rand. Now, what I have not done here, and I must explain, is that I did not here show every single asset. If we had a live 2-way session, I was going to ask you for you to say to me why not, and your answer would have been, I'm sure, quite simply because of the fact that there's an accrual claim in favor of the wife, possibly because we don't know yet, and also because of the fact that she inherits the residue. Those things are not specifically bequeathed to the children will form part of the residue. She's to get all of that, and all of those things for now rolls over. We may find, and I accept at this point, and that is why I spoke about it earlier, I accept at this point that that's what's going to happen. The wife is not going to say, sell the house and give me the cash to give me the accrual plan. She's going to take those assets, most probably. So those assets are going to roll over. But if we get to a point, and only later will we know, that there's a massive shortfall in the estate and he's uninsurable, and there's a good chance of how can I put it, the assets having to be sold. Remember, then those assets do not roll over. So what I normally do is exactly that, check out what the rollover is going to be and then come back. But in the exam, you do what I've done here, except perhaps to be on the safe side, I would have listed the other assets that rolls over to the spouse. And I checked that with Lelani from the FBI during one of the sessions. If an asset rolls over, you know, there are still values, there's still a disposal under Section 9HA, and there's still values, a market value and a base cost involved. Lelani said when I asked her in a classroom with the people there, I said, I don't want to put you on the spot because you can never ask anybody involved with an exam any questions about it. But as a general exam point, if you should get in the exam assets that roll over, you can just say, let's say the apartment in Kenilworth went to the wife. You could have just said, apartment in Kenilworth, roll over to spouse, 0 capital gain. Okay, so all of the others, I would have mentioned that if I was to write the exam. 300,000 annual exclusion, taxable capital gain 40%, and then the CGT comes to 68,400. And as I said, that we're going to carry forward into our next calculations. Question 1, it should be solution to question 2. I started with that. I've changed them around. Calculate the accrual claim that Susan will have against Michael's estate under the Matrimonial Property Act if Michael should die today. The assets are given, as I said to you earlier on. There is no need to go and write down in his accrual calculation a full list of all of his assets. They are listed, they are given. It's 9.91 million. You can just say assets as provided or as given. The life assurance policy that's payable to his estate is part of the accrual. We do take that into account. And then, of course, 12,410,000. And then I deduct the liabilities. The 560,107 are the liabilities given by the author of the case study, and the 68,400 is the amount of capital gains tax payable on the death of the husband. We treat that as a liability. So the accrual in Michael's estate in the event of his death, should he die first, and should that be, shall we say today, is 11,781,493. Let me just clear it all, and then we can go back, and I'll go back to the next slide. Here we go. Oops. Accrual for Susan. Assets also given, 3790. The asset donated during the marriage must be excluded. Now, the rule in respect of a donation during the marriage, I'm sure you know, is that the donated property must be excluded from both the estate of the donor and also from the estate of the donee. Because the husband has already handed it over to his spouse, the asset value given already excludes them. They are now included in Susan's estate, so all we need to exclude is to exclude it from her estate. And if we've done that, they've been excluded from both. So we exclude that, and we deduct then the liability value of 40,000 that's given. And I'm not going to now take you through the entire calculation value-wise. I'm just going to say the difference between the accruals is that. After we've divided it by 2, it's that, and that is a claim in favor of Susan, of course, and that claim is deductible for the purposes of the estate duty calculation. Right. Question C. Calculate the residue that will accrue to Susan in terms of Michael's last will and testament if he should die today. Ignore estate duty in the calculation. Now, why do I say that? I'm sure you've read in the book, I'm sure you all know the rule, but just as practice, we can actually look at two residues when we do these analysis. You've got to do it in a sequence to get the flow correct. The one is the Section 4Q deduction, which we need merely for the purposes of Section 4Q, which says anything that accrues to a spouse of the deceased, we can deduct. When we get to that part of our estate duty calculation, if you think about it, we have not yet determined the amount of estate duty payable. So at that point, what we deduct is just the residue as it is before the residue has been reduced by the estate duty. We then continue our calculations, and then when we eventually get to the point where we determine what it is that each heir will inherit, remember then what we've got to take into account is that the residue of the estate will have to pay the estate duty, except for, of course, if there is an apportionment in respect of those parts, and therefore we then reduce the residue by the portion of the estate duty that the estate must pay, and then we divide it between the heirs. The calculation of the residue. I've said this plenty of times. The important thing here is that you start with the correct amount. The assets that were given, as per the facts in the beginning, 9.91 million. All of those assets forms property in the estate for estate duty purposes, all of those assets also will be included in his estate for administration purposes. There's nothing listed there like usufructs or that in fact is payable to the estate, because the children or the residual heir, who's the wife, can also potentially inherit that. Then we've just have to deduct the cost, the funeral cost. You can see the CGT must be paid, admin, the accrual claim itself. Now, the position is, of course, that the accrual claim will have the effect of reducing the residue. In this case, what will happen is that the surviving spouse will have an accrual claim, which is 4.9 million. And then in addition to that, she will also get the residue. In other words, in this case, if you think about it, the surviving spouse is actually going to get everything after the legacies to the children have been paid, and after the expenses and liabilities have been paid. So it doesn't matter really as far as to what she will get. The accrual claim is deductible for estate duty purposes, and so is the residue. So I've seen in one of the textbooks be done, because what's the difference anyway? The surviving spouse is going to get everything that remains after those legacies. But in this case, we do it. It's an exam and you are asked to do it. So there's the accrual claim as we've calculated it. Executors' fees. Now the executors' fees, 495,159, obviously will be done on that. If you get stuck in an exam and you're not sure what is subject to executors' fees and what is not, and you've got to do a quick calculation, 9 times out of 10 you're going to be correct if you simply ask what are the, or let me phrase the question differently. If you want to know what is it that the residue that must go into the estate for the purposes of the residue, just ask on what amount is the executor's fees calculated, and then you should be correct. Executor's fees calculated on that amount, obviously, the 12,410,000, 495,159 liabilities, and then of course the legacies come out of the residue of the estate, and those legacies are the 2 million rand, the legacy of the apartment, and the legacy of Michael's shares. So these amounts here that are highlighted at the bottom here in that circle, those three values, plus added to that the policy that is payable to the estate, should be equal to the net value of the person's estate for estate duty purposes. In this case, we have a residue of 155,587, and that is the residue of the estate for the purposes of Section 4Q, and of course we must adjust it later on when we do a distribution. And then question number 4, calculate the amount of estate duty that will be payable if Michael should die today. Ignore apportionment of estate duty. Now, I've specifically said that here because I'm not going to do it. The question that I often get from students, if you simply are asked to do an estate duty calculation and then a cash shortfall, must you do an apportionment? Strictly speaking, unless you're not told to do so, like I do here, you have to do the apportionment. In many cases, depending on the asset makeup as to what the others are liable for and what is the value of the estate, a large portion of the estate duty may be payable by some other person, in which case you want to take that into account in the value of the person's estate on death and who's going to inherit what. So keep that in mind, that what you've got to remember, always look for life insurance policies payable to the estate, that the estate is liable for estate duty. However, if the life insurance policies are payable to third parties, you must do an apportionment, and those people who get the proceeds of the policy or the benefits under the policy is liable for the estate duty on that and must pay it into the estate. If the policy is payable to a surviving spouse, because of the fact that it qualifies for deduction under Section 4Q, you can ignore that for apportionment purposes. Right? Once again, here, you can start with a list of assets on the safe side. What I've just done is just to take the list as it is and start with that, because all of the assets on that list form property and there's nothing to be added. If you should find that there's a list like that and you must rewrite 20 assets in the exam paper because there's just one in there which is not property, then you can also take a shortcut and say total assets is given this asset that should not be included and put the balance. Right? Deemed property, policy A is payable to the estate, and then policy B to his spouse, that's deemed property as well, and policy C to his children, that is deemed property as well. And then there's an unapproved group life policy that's also payable to her. So in total 5560. So that for estate duty purposes, the total value of the estate is 15,560,000. Right, there we have it. Funeral expense. As you can see there, the 20,000 given. Administration fees, once again, if the examiner gives you an administration fee that includes the master's fee, just use it as given. I had, I think, about 3 emails where people asked me for information regarding the increase in the executive's fees. And I went back to them and I sent them a copy of the regulations that came out that says from the 1st of January this year, what has increased was not executive's fees, but master's fee. So remember that the master's fee has increased, and that therefore is a possibility that to test you on that for the first time, perhaps the examiner will say the administration fees does not include the master's fee, to see whether you know about the change. Then we deduct for estate duty also the capital gains tax as calculated. I'm sure you know, but you'll be glad to hear that if your capital gains tax calculation gave an answer of only say 30,400, and you wrote in here in the space where the 68,400 is, and you wrote there 30,400, you will not lose a mark. They mark you with the error. You may have lost a mark in your capital gains tax calculation for the error there, but not here. The same with the accrual claim. I've just taken the accrual claim as we've calculated on the earlier slide. If yours in the exam differ from what you've calculated earlier, at this place here, you get a mark for showing the knowledge that the amount of the accrual claim is deductible. So as long as it matches what you've calculated earlier, even if that's incorrect, yeah, you get your mark. Liabilities of 560,107, and then you've got the policies payable to the spouse and the residue then to the spouse as calculated. And if we do that, you see here that the net estate comes to an amount of 5.63 million rand. Now, I'm not going to do that, and I hope I've done it correctly, but what that should reflect is that that is also equal to the total to those legacies, not to the wife, but to the children, plus any life assurance policy that goes to the children. And because those are the only items that can possibly attract estate duty because of the fact that it doesn't go to the wife. Then we have the Section 4A abatement. I'm not going to look at multiple spouses and how it works then and that. Just going to look at the normal rule as it applies in this particular case study here. And guys, it's just about 15 minutes or so. I'll give you a 5-minute break. So hang on there. It's not too long. I know it's hot in Cape Town, probably nice and cool up country. Right. 4A abatement. This guy has got a predeceased spouse. Her estate was left to him In other words, it was fully, or it was left in such a way that the dutiable or the net estate was 3 million rand. In other words, everything went to his wife, to her husband who survived her, except for life assurance policies, the net value of which, the estate duty value of which was 3 million rand that went to the children. The rebate that she qualified for of 3.5 million rand, only 3 million of that was needed to cancel the 3 million rand net estate. So she effectively only got an abatement of 3 million rather than the full 3.5 million. Now, the actual rule, people talk about adding back what wasn't used. Yes, that's correct. It will also work out. But if one more or less follow the wording of the Act, it says you must take the abatement, which is 3.5 million rand, multiply it by 2, and that gives us 7. And then we go back to the estate of the predeceased spouse, and we deduct from the 7 the abatement that she did get. Remember, she did get 3 million rand, and that was used to cancel the net estate of 3 million rand. So that leaves us with 4 million rand as an abatement for this person here. It works out the same. She didn't use 500 of her abatement. He's got 3.5, and it comes to 4. And I'm just going down the actual wording of the Act. So there's your dutiable estate, and then estate duty payable, 326,000 rand. Now, in a case like this, in practice, I wouldn't bother about doing an apportionment of estate duty, because remember, the estate duty is going to be paid in any event by the same persons that inherit the estate after the wife, as you know, by way of the wife, she gets the residue. So I wouldn't bother about it, but in practice, if it is a large amount, and if it's perhaps persons that are not related, not inheriting, it's a good idea to do it. In the exam, it's a good idea to do it. Right. The next point is, let's calculate whether there will be enough cash in Michael's estate to pay for all the liabilities, the taxes, the administration expenses, and cash legacies if he should die today. Now, we're going to ignore the apportionment of estate duty, and we do that because this particular question says so. If it's not too complicated and you do have the time, do it and take it into account in your cash flow. And also assume that the accrual claim will not be satisfied in cash. Now, that's a difficult one that one faces when you get the exam, and that is that essentially, you will see that they discuss it in the Comprehensive Capital Gains Tax Guide by SARS under the rollover. They say that the accrual claim is essentially a cash claim. In other words, the surviving spouse can say, I want a cash amount to settle the accrual claim. But why would she in this case? If she wants a cash amount, all of the assets that, except for the businesses, all of the assets that are to accrue to her are going to have to be sold to satisfy the accrual claim, and she's not going to be able to, and then she can't buy them back. In this case, 999 out of 1,000 surviving spouses is probably just going to say, just hand over the estate after the legacies have been paid, to me, as long as the liabilities can be paid and the legacies can be paid. I'll just take the rest in whatever format it comes. Now, remember that about 2 years ago, in Section 9HA of the Income Tax Act, it was confirmed, there was a bit of a debate about it before that where on death an accrual claim is in favor of the surviving spouse, if the assets are transferred to the surviving spouse in settlement, in satisfaction of the accrual claim, we also have a rollover, and those assets then will not attract capital gains tax on death of, in this case, the husband as a result. Right, let's look at the solution to question 5, the cash liquidity analysis. What you must always start off with is the cash in the estate. Now, in this case, there's the cash investments and there's the insurance policy payable to the estate. I've seen many times that a person start off, he says, share portfolio, unit trust portfolio, cash investments, insurance to estate. I'm not saying it cannot be used as cash. It could be sold by the executor. It depends on what the circumstances are at the time. You may find that it may not be a good idea at the time to sell them. So therefore, what I normally do, and I suggest you do that in the exam, when you start your cash liquidity, take those items firstly that definitely will form cash. Cash investments, as we have here, insurance policies payable to the estate, and one where I can remember being an assessor of a case study exam many years ago, where the students actually, 60–70% of them, found there to be a shortfall in cash because they only took the cash investment, say in the life insurance policy. But what they forgot is that the fact stated that there was a buy and sell agreement in place, and that in the event of the death of the particular person they were dealing with, his shares would be sold for cash to his co-shareholders, and it was a massive amount. Most of them didn't take that into account. So don't just look at cash assets now, look also at assets like buy and sell agreement, where you know the executor can do nothing else but to turn it into cash and take that into account as well. And perhaps you should mention in the case of a shortfall, write down, say to the examiner, the reason why I haven't taken in the unit trust is for this reason. But, you know, in the case of an emergency, if there isn't other cash, he can at least sell the unit trust under the circumstances where he wants to save the house or not sell that. So then we look at the cost to be paid in cash, the funeral, the admin fees, the executor's fees, the capital gains tax, the estate duty. Of course, I've taken the full amount, but obviously if there's an apportionment, one would just take the balance, the liabilities, and then the legacy in cash to the son, which means that it leaves us with a cash shortfall of 649,666. So that's the shortfall. Let me just make these highlights disappear, and then I'm going to take you. I thought that was easier than that was. Erase it, and then normal. Right, here we go. Sorry for the delay. Number 6, and I think after this number 6, we'll take that break so that we don't have to start a new question before the break and then break. Provide Michael with 2 options that can be used to eliminate the cash shortfall in the event of his death. Advise him that should not be his as to which of the 2 options would be the best. Use a monthly premium of 14 Rand per 10,000 of life cover if you should recommend life insurance. Just a short discussion here, most of which I have already spoken to you about. The assets will have to be sold if the shortfall is not insured. In other words, there is no cash in the estate to pay that. And let us say, for instance, that the executor then sells unit trust in order to pay for that shortfall. And that unit trust, as it is at the moment, will roll over to the surviving spouse because it's part of the residue to the estate. And therefore, we didn't take into account that there may be capital gains tax on that because we showed it as a rollover. If now, because of the shortfall, the position is that an asset must be sold, we must go back and change the position regarding the capital gains tax and the accrual. The accrual claim will be satisfied if all the assets in the estate, other than the legacies to the children, are transferred to the surviving spouse. I've already said that in this case it's a simple one. This will, however, mean that assets will have to be sold to pay the cash legacy to his daughter. To prevent this, life assurance can be taken out on his life. Okay, so in other words, there's a shortfall. Even if it rolls over, the daughter must be paid. In other words, what I'm saying, legacies can also cause a shortfall in cash legacies. To prevent this, this life assurance can be taken out on his life. Now the problem is that any policy payable to the estate will increase the accrual. The cash shortfall is 649,666. Let me just go back and see if that's correct. Yes, it is. And that does not include the accrual claim. If the accrual claim is also to be paid in cash, what is the estate must pay is actually 5.6 million odd. Now, if the accrual claim is to be paid in cash, an additional cash amount of 5.6413 is needed. In this case, it's not necessary, because the assets that will have to be sold to raise that sort of cash is any event going to be part of the accrual that the wife gets. And if you now take out insurance, what she just gets is the insurance plus those assets. So I think in this case, one must just not take it into account. In this case, it would be best if Michael nominate his wife as beneficiary so that she can, if necessary, pay it into the estate to preserve the assets. In other words, in this case, if he takes out a policy and nominates his wife, it'll pay to her in the event of his death, because it is payable to her and not to his estate. It's not taken into account for accrual purposes, so we don't have to increase it because of the fact that it increases the accrual. We also don't have to increase it for estate duty because it's Section 4Q deductible, and we also don't have to increase it for the purposes of the executor's fee. So in this case particularly, I'm not saying as a general rule, you can simply take out that policy for an amount of 649,666, determine the premium of 910 a month, he can pay it, and that shortfall will be solved. The next question is a little bit longer. I wanted to take a break at 3 o'clock, so I think if it's okay with you guys, if we take a break, I see now it's sort of nearly 4 minutes, 3 minutes to. If we can start about, say, 4 minutes past 3 o'clock, and we take a bit of a break. You can go and have some water, do what you need to do. I'll be here, and I'll see you at 4 minutes past 3. Thank you. That I'll just get a message here. It's time to start. That I am unmuted and that I can go ahead. Before we look at the next question, if you can, Kirsty, just write me a message to say that I hope that you can all hear me and that we can proceed. In the meantime, during the break, the questions have been sent to me, and I'm just looking at the message. It says all good, and there we go. I'm just going to answer a few questions that you've asked that's been asked by various persons. The first one, Fazana, hi, why can't Michael qualify for the small business assets excluded for CGT? He meets all of the requirements. I answered a question like that to somebody on the web last night as well. You will see under exam circumstances that an examiner should, before you can just assume that paragraph 57, 1.8 million rand exemption applies for CGT purposes, should give you a set of facts that, if you read them, will satisfy you that each and every single requirement of the Act has been met. Also, going back on experience, an old case study that once I marked, people just assumed in a case study years ago that because the business looks a small one, that, the requirements are met and therefore deduct the 1.8. As I said to somebody last night, what is the total value of the assets in the business? You don't know. There's requirement that the asset value of the assets must not exceed 10 million rand. If the examiner is completely silent on the value of the assets in the business, you can't assume that they're less than 10 million rand. A business may be worth, the shareholding may be worth 5 million. That doesn't mean that the assets are worth less than 5 million. You could have a situation where the total assets in the business is 25 million and the liabilities 20, and that's what makes the value of the business 5. So make sure that take those requirements with you and make sure that every single one is met. Don't just assume. Maybe I don't know what the examiner wants, but I would not deduct the 1.8 million before I'm absolutely sure that the person qualifies for it. And if you want to then assume that it is the case, if that's what you prefer, then write that you assume that the asset values or whatever requirement it is that you miss are not worth, are the following. I personally, I want to see the requirements, because in practice you can't make assumptions. You can't say to a guy, I'm going to assume that your asset value is less than 10 million, so I'm going to give you 1.8 million. No, I wouldn't do that. CGT and accrual. In past FPI papers, the CGT was not included in the accrual. Marius says it must be included in accrual. Can FPI, which way CGT is treated for accrual? Okay, that is from Bo. Bo, I remember you quite well. You sat in Port Elizabeth on the left-hand side. I can clarify it for you. I think it is deductible. There's been a debate about it. I can remember being at an FPI conference where with myself and Wessel were stationed, and an attorney actually asked him, and Wessel had to write an opinion about it. I think people generally accept that it is deductible. All I'm saying is, and why I leave it out of account, and especially in the case study, Bo, that you referred to, is because in that one, I did it that way so that in the question I can then argue for the person to calculate the accrual and to say what the implications are. So I can assure you and that if you just want to know for the exam, Bo, that you can take it into account and you can deduct it. It is just that, practically in practice, if you do it first, you may have to make adjustments later. I hope I answered that. Nice to hear from you again, Bo. And also Eric van Wyk has left. Carmen Marius quickly confused. Cash legacy for son. I don't know, Carmen, what you mean by that. Did I get it wrong? I'll have to go back. Is it perhaps for the daughter, or what do you mean by that? I'll have to come back to you on that. I have your email address, so I can always come back to you about that. I want to get to this quickly. If the wife pays, question 6, the policy proceeds to the estate for her own money, would it be a donation for donations tax purposes? Esther, that's actually the best question I've had for a long time, because people don't think about that, and you did. No, it's not a donation. If she pays that money into the estate, let's say there's a debt of 600,000 that must be paid, and the only asset that in the estate is one of $1 million. Then if they sell that property to pay the debt of 600,000, she will inherit the balance which remains after the debt has been paid, and that's 400,000. So all she inherited was 400,000. On the other hand, if she should take that policy of 600,000 and pay the estate 600,000 to prevent the asset that will be sold, she now gets the full property, which is retained, which is worth $1 million. So it's not like giving it to the estate. You only do that under circumstances where it's going to come back to you by way of an asset that would have been sold and you would have got the rest of the money. You now get the asset in full. So you actually pay for the rest of the asset value that you don't inherit. And then the next one, I think it's the last one, from Carmen Marius. If they decide to take out a policy payable to the estate and increases their estate duty and executors' fees and master's fees, what do we divide by? I'm going to stop there and answer you that it is actually on a slide that we are still to discuss, so that is going to come. Question 7. Michael is eager to retire now in order to join Michael Importers Pty Limited. Calculate and advise Michael whether he has sufficient retirement capital to take early retirement today. Assume that he can earn 8% per annum on the capital that he invests, and that the inflation rate at which his post-retirement income is to increase is 6%. Let me just see. There we are. It's a simple. This is just to take you through the process. Calculation of retirement capital. Firstly, what you do is to look at all the capital that will be available in the event of his retirement. There's the living annuity. That means that he already is a living annuitant. He has already retired from that fund. That's 1.189 million. The Provident Fund is 4.5 million, and the share portfolio, which is also to be taken into account, 1.2 million rand. That's 7789,000. The income that he needs after retirement is 70% of his current salary, which is given at 900,000, which 70% of that is 630,000 rand. And you've seen there, you know why we use the resultant rate. Resultant rate is 2 divided by 1.06 equals 1.88679, which is the shorter way of calculating it. Let me just see, there's a question that is question 6. If the wife pays the policy proceeds to the estate would it be a donation tax? I've answered that, I think. I don't see a new question, but the warning came up that there was. Okay, so what we do next is we calculate the amount of capital that he's going to need at retirement date to provide him with the income that he needs. And that's quite simple. The 630, we calculated that as being the current amount that he needs, and if he needs that for a period of 22 years is given, and we discounted by the resultant rate, it's 11,470,305, and then the shortfall would be the difference between the two. Why did we not project all of that into the future? Because he actually wants to know, can he retire now? So we're not looking at a need that exists at a future date. This one is a little bit different in as much as that we're looking at a need that is there now. Question number 8, advise Michael as to what impact the fact that his wife's daughter is nominated as beneficiary to his existing living annuity will have on his wife's retirement income after Michael's death. Make a recommendation to eliminate any possible problem. Now, this living annuity, the question is really what happens to it in the event of his death. Now, just the rule there, you know that when he dies, either he can, or as a default, in other words, if he dies and he has not nominated a beneficiary in respect of the living annuity, it will actually be payable to his estate. And if it's payable to the estate, it will be an asset in his estate because the executor will receive it in cash. It will still be subject to lump sum tax. That will have to be deducted. And what will happen is that it will either go into the residue of the estate, or it could have been specifically bequeathed to somebody, probably just in the residue of the estate. And whoever inherits it will get the cash. Or he could have nominated a beneficiary. If he nominated a beneficiary, then of course the beneficiary has the option either to take a lump sum or to cash it in, or rather not to cash it in, but to continue with the living annuity, and can even do a combination of the two. The bottom line is any amount taken as a lump sum on Michael's death by a beneficiary, or even if payable to his estate, will be deemed to be a lump sum that is accrued to Michael immediately prior to his death. The estate will have to pay the capital, I beg your pardon, the lump sum benefits income tax on that, and the estate can recover it from the person who's entitled to get the proceeds, or who has reduced it to cash. Let's just look at the answer to question 8. If he dies, the current living annuity will go to Susan's daughter. This means the effect will be that Susan's income will be reduced. He should nominate Susan as beneficiary rather than the daughter, and then she can, in turn, nominate her daughter as a beneficiary, so that at least she can get the drawdowns on that until such time as the daughter needs it. That is just a recommendation. Question number 9. Advise Michael, and let me just see, I see there's a further question. Why do I not see a new one? Is there still? Let me just see. Hold on a second. Confused cash legacy for son. Carmen, I will have to look at the facts to come back to your question just now. Pays the policy. Okay, I see I've got the one here. This is from Carmen. Question 6 solution. If they decide to take out a policy payable to the estate and it increases estate duty, I said I'll discuss that later. Sorry, I'm wasting your time. Let's get to question 9. Advise Michael as to who is liable for any tax on the dividend income that Susan receives on the investment in the unit trust fund in her name. If it was interest, I said to you earlier that she would have been, or rather the interest that she receives would have been taxed in Michael's hands, and that's in terms of the provisions of Section 7(2) of the Income Tax Act. Remember, dividends are included in a person's gross income in full for income tax purposes. The full dividend before it's been reduced by the dividend tax. And then under Section 10(1)(k), there's an exemption that exempts the whole lot. So there's nothing where the time you get to a person's income, the dividend has been from income tax has been removed. So there's nothing that can be, in this case, in no dividend that's included in Susan's income for income tax purposes. There's only the dividend withholding tax, and she, of course, will be liable to pay the dividend withholding tax. Question 10. Michael wants to know whether a buy and sell agreement between the other shareholders is still possible. Remember, he wants to bequeath these shares to his son. His son has got some shares, but there's also another person with shares. Taking into account that he wants to bequeath his own shares to Michael, Michael wants to bequeath it to George. Advise him in this regard and state whether life insurance taken out for this purpose will be exempt for estate duty or not. That's obviously under the provisions of Section CCA1A. Recommended here is that George and John being the other shareholder, that they enter into a buy and sell agreement in respect of the shares that they want to sell. And that for now, Michael stays out of it because he wants to bequeath it to the children. The contract that George and John should enter into, because both of them are shareholders, if they take it out to meet all of the requirements of Section CCA1A, and there's no reason why it couldn't, the policies will be free of estate duty. You know what those requirements are, and then they can in future amend the agreement once George has inherited from his father. And if they then want to restructure the buy and sell agreement, because then at that stage George will have far more shares, they can restructure the buy and sell agreement, enter into a new agreement. Just remember that this is just a general point, that the agreement must be in line with the memorandum of incorporation of the company. And then something just to take you through that as well, just as an example, do a complete income tax calculation for Michael for the 2017-18 year of assessment. Ignore the taxation of retirement fund lump sum benefits. Okay, most of this is given. It shouldn't be, it's not a difficult exercise, but let's just talk through it and see what in addition to it we can discuss. The 900,000 salary, obviously part of his gross income. The drawdown, the amount, the 2.5% that he takes from the living annuity is part of his gross income. So is the bonus. And then we've got all these fringe benefits, the medical scheme contribution by his employer, the group life premium, the income replacement premium, and the Provident Fund contribution, all made by his employer. So all of those are fringe benefits that are part of his gross income. Interest of 21,000, foreign dividends of 13,600, dividends from unit trust, and dividends from the JSE. So all of that is included. And let us then look at the next slide. Let's get my cursor back and look at the exemptions. Interest, dividends are 56,850 are fully exempt, and then your foreign dividend is, portion of that is exempt 25 over 45 times 13,600, 7,556, and that gives us the income of 115,268. And then, of course, in this case, retirement fund contribution, we take that into account, but how the maximum is calculated, that is well within the maximum. We do that as a separate exercise. We deduct the RA fund contributions, and then we calculate the tax. As you can see here, and this is really what I want to point out, in this case, the person has got the primary rebate under the age of 65. There's a medical scheme tax credit, and there's the additional medical scheme tax credit, and the tax payable is 324,594. I don't know to what extent you will be required to do that. Hopefully not a full tax calculation in the exam, but under the medical section of it, I've seen in questions before that you could be asked to explain to a client if he should take out or become a member of this medical scheme, what his tax credits will be. So make sure that you can do that. Just to take you through that, it should take us just a few minutes, not long, and then we can carry on with the other stuff. We've got the medical scheme contributions, 44,400. What you've got to take into account is that the contributions that is made by the employer, because they're included in the gross income of the employee, are also deemed to have been made by the employee. So the 44,400 there that we start off with is, of course, the total of the contributions made by Michael and his employer. Then we deduct from that. Now remember, this is just the calculation of the additional medical tax credit. Then we deduct from that 4 times the standard medical tax credit, which is in terms of section 6A. There's your medical scheme tax credit, 9720. You know how to calculate that. It's 303 Rand, I think, for each of the first 2 members, and then I can now not call for what for the next one, multiplied by 12. There you have it. Then you take 4 times that medical tax credit, and you deduct that from the total contribution, and you've got 5520. I see there's a question. I'm just going to finish the slide. Then we add 100,000, which are the, when I say qualifying medical expenses that he could not recover from the medical scheme. Add that 105,520, and then what we have is that we have the total amount from which we must deduct 7.5% of his taxable income. So you go back to his taxable income and you take 7.5% of that. You can use this slide as a template if you have to do it. And then you get 25,857, and your additional medical tax credit under section 6 paragraph or 6 capital B is 6464. And if we go back on the slide, you will see that that is in fact then the amount. Let me just get my cursor back. There's some movement that I must do here before I can do that. Click. You see there 6464 has been deducted. Okay, I'm now going to just clear the highlightings and erase it all and get my cursor back, and I'm going to go to the next question. But before that, let's see what that question is. Is that question 6? It's still the same question. I don't know if I've missed something. The last one, if the wife pays the policy proceeds to the estate, I think I have answered. Would it be a donation? So I'm going to go back, leave that until the end of the presentation, and perhaps look at all the questions again if I've missed something. Right, and then calculate the amount of any other tax that Michael is liable to pay for the year. You must take into account, although the dividends that we've included into gross income have actually been part of gross income and exempt, they're not exempt for dividend tax. And dividend tax, of course, is now 20%. So that is a simple little question. Question 13. Bit of business insurance. I've concentrated here on this one on estate planning because the previous one had a lot of business insurance and a few other things in it. Still more business insurance. Michael Importers has recently applied for a loan of 400,000 from the Orange Bank. The loan was granted and Michael had to provide surety for the loan in his personal capacity. He's now worried that the bank may claim the outstanding amount from his estate in the event of his death. Advise Michael on how to ensure that the amount will not be claimed from his estate. Further advise him what the tax consequences will be to the company if your plan is implemented by the company. Now, the solution, the company can insure his life. The loan is for an amount of 400,000 rand. However, let us discuss, this is a contingent liability plan. Let us discuss, or it can be a contingent liability plan, that would be one, or the other one would be for the company just to take out a policy on his life. Let's look at that. The policy that the company takes out on his life to secure this loan. We may argue that Michael has only got 50% of the shares, and therefore the policy will not be a family company in relation to him, and that it will not be dutiable. I say there 48%. Does he own 50% or 48%? I will have to go back on the facts. I see I've got 50 at the bottom. Let's just leave it at 50 for now, just for the calculation part. In terms of Section 4P of the Estate Duty Act, 48% percentage of the shareholding that he owns of the policy proceeds will be deductible for estate duty purposes. The amount for which his life is to be insured, inclusive of the amount of estate duty that the policy will attract, is the following. I'm going to get the highlighter here and explain to you how this works. Firstly, if the policy if the loan is 400,000 rand, we can argue that the policy that the company takes out is going to be dutiable, irrespective of his shareholding. However, Michael and his son together owns 52% of the shareholding. So in other words, if we look at Michael himself, he owns 50%, his son owns another 2%. So on his own, he does not control the company. However, together with his son, he can control the company. So it's a family company in relation to Michael. This 48% here, you listen to me now, that is an error. Michael owns 50%. I hope I remember the facts correctly, but it's 50% him, and 2%, his son is 52%. So what we've got to do, we've got to increase the policy to be taken out from 400,000 rand to an amount that includes the estate duty that the policy is going to attract. Now, whether he's got 50% or 48% or 20% or 30% doesn't really matter, because one can argue here that he was part of, if it's a deferred comp, we can say that he was part of the decision making, not the deferred comp. Let me say that again. If this was a contingent liability policy, if they went for that route, the policy would definitely be dutiable, because he would be part of the decision making process of entering into the contract. In this case, because he and his son owns 52%, together it's a family company in relation to him. So therefore, the additional amount of life assurance that must be taken out is the following. Under normal circumstances, if a policy is dutiable, we can say that the person will retain 80% of the policy because of the fact that 20% of estate duty will disappear. However, in terms of Section 4P of the Estate Duty Act, you will recall that it says that one can deduct for estate duty purposes so much of the deemed value of the policy for estate duty purposes as was taken into account in the valuation of shareholding of that person. Now, in this case, if the company takes out a policy on Michael's life and they pay a debt with it, the company value actually increases, and on his death, they will have to value those shares without taking the liability into account because it is no longer there. But in terms of section of 3CA or 3.3 of the Estate Duty Act, it's still deemed to be property. So here they allow a deduction of so much of the policy that is deemed to be property that was also taken into account for the purposes of the valuation of the shares. Now, we can now claim a deduction, and the deduction is, to put it simply a percentage of the value of the policy, the dutiable value of the policy, the deemed property value of the policy, and that percentage is equal to his shareholding. For instance, yeah, if he had 40% of the shares in the company, we would take 40% of 20. If he had 60%, we will take 60% of 20. In his case, let's accept that he's got 50%. Together with his son, he's got 52. The family's got 52, but he himself, he just owns 50. So therefore, what we do, we divide the estate by a factor, which is 80. 100 divided by 80. Remember, that's the same as dividing by 0.8. But if we say 100 divided by 80 plus his percentage shareholding multiplied by the other 20%, which is not dutiable, then we get, in this case, half of it's 80 plus half of 20, and that is 10. So I hope I've done it correctly. Please, if it's an error, let me know, because I can't just do it in my head. I've grabbed a calculator, and that would be 400,000 divided by 0.9, and that's correct. 444. Always worries me when I see like 444. So therefore, the policy that we must take out to cover him in this case would simply be 444. Now, if you go and practice that perhaps tonight in the verse, and what you do is to take a policy of 44,444, deduct from it 50%, in other words, an amount equal to 50% because he owns 50% of the shares, you will be left with 22222. It sounds funny. And then 20% of that, and if you then deduct that, you'll be left with a 400,000 rand. Right? Let me get back to my erase all drawings. There's a bit of a thing that I must do here. Did I make that come up? I'm going to. My apologies. Sorry. Okay, I'm going to just concentrate for 1 second, just to erase all drawings, just to make sure that I'm back with you. I'll say, right, let's go to the next question. Then, if they go the route of contingent liability, rather than just for the company to insure his life, the only company must enter into a contract in terms of which the company undertakes to use the policy proceeds for no other reason or purpose but to repay the loan on Michael's death. So if they repay it, his estate cannot be affected. The premium that they pay on this policy will not qualify for tax deduction because, as I said previously, they're not insuring against a loss. They're insuring to cover a capital debt, and the policy in the end will be exempt. Right? Question 14. Advise Michael what the income tax position will be in respect of the unapproved group life policy that will pay an amount of 850 to his wife in the event of his death. You know that, I think it was in 2015, I speak under correction, the position was changed so that you can no longer, as an individual, deduct the premium in respect of an income protection policy. And in respect of an unapproved group life policy, the position would be that it's included in your gross income, the amount paid by your employer, and you do not get a deduction. So the proceeds will be included in Michael's gross income as it is deemed to have been paid to him immediately before his death. That's what happens when it pays out, and it will be exempt. Question 15, and we will have still a lot to do, and also questions, so excuse me if I'm talking a bit too fast. The rules of Michael's Provident Fund allow that any portion of the retirement annuity, I beg your pardon, of the retirement benefit can be taken in the form of a living annuity. Assume that Michael has decided to retire now and that he wants to take a lump sum that after tax has been paid will be sufficient to repay the outstanding balances on his car and housing loans. Calculate the amount that he must take as a lump sum in order to repay the two loans. This is just a bit of a, I wouldn't call it a mathematical skill. I've seen it in exams more than once. It's a pure punt. So the real question is here. A person is about to retire. He wants to take a lump sum, but he only needs the lump sum to repay certain stuff. In other words, he wants to know, I need to pay the house bond and so much. Now, if you want so much as a lump sum, the reality is that you will have to withdraw a bigger lump sum because the after-tax amount must be equal to the debt that you want to settle out of the money that you get. So you must be able to work out what is the actual withdrawal that he must take so that after tax you will have sufficient to pay the liability. Now in this case, the two loans that he has, the outstanding value of that is 560,107. Now, so that's the lump sum that he needs. If he should take some 560,107, there's going to be some tax implication and he's going to be short. So he needs to increase it by income tax to be able to do that. Now, you should know that that 560,000 rand, because of the fact that he's going to retire, that the first 500,000 of that will be taxed at 0%, and that the tax that he will pay will be 18% of the 60,107. And what I've done then is first ignore the amount that he wants. Just assume that what he wants is an amount equal to the debt that he wants to pay, and calculate the tax that he will pay if that is the debt, if that's the amount that he takes. And the tax on 560,107, in other words, 18% of 60,107 is 10,819. Now the problem is that amount of 10,819, that is that if he takes a lump sum to cover that in itself will tax at 18%. It will stay in the 18% bracket. So what you've got to do, you then take that tax that you've calculated, and you look at what marginal rate of tax it will fall, and hopefully it won't cross two marginal rates. And in this case, it will still remain, if he takes an additional small amount to cover the tax on the 10,819, it will still fall within the 18% lump sum bracket. So he's going to retain 82% of it. So divide that 10,819 by 0.82, and you will have to then take a lump sum not of 10,818, but of 13,193. Now, if you take then that and you deduct that from the total amount, or you add that to the 516,107, you get 573,300. And if you take the tax away from that, you will have the amount that he needs to repay the loan. Once again, let me do the slide clearing thing. Right? And okay, there we are. Thank you. I'll check questions now. Maybe I should leave the questions to the end if you don't mind, because if I don't get to them from you, I can always email them to you tonight. Once Michael has retired and joins Michael Importers on a full-time basis, the company will start declaring dividends. This we've done. Advise Michael what the effective rate of income tax is that will be paid on the profits made by the company if the rate of company tax as well as the rate of tax on dividends are taken into account. I've done this before with you. I think in the other exercise, you'll agree with me that company tax is 28%. So out of 100, 28 rand will disappear. Dividend tax, if 28 disappears out of the 100, the company only has of that 100 of profit, which would be the company post-tax profit will only have 72 rand left. So 20% of that is 14.4. They can only distribute a dividend, in other words, of 72 rand. So the effective rate is 42.4%. Assume that Michael dies before he can retire from his Provident Fund, and assume that the full Provident Fund death benefit of 5.4 million will be paid to his wife, Susan. Advise Michael what the options will be that are available to Susan as to the format in which she will be entitled to take the benefit. Advise him what the income tax consequences are in respect of each option, and who the person is that will be liable for the income tax. This sounds like a simple question, but it's something you need to know. It's something that possibly cannot come up. Option 1, here I answered in a theoretical basis, but in a case study, it'll be more tell Susan which one of the options is most suitable. Yet I'm just listing them. Take the first option, to take the full benefit in the form of a lump sum. The lump sum tax is payable by the estate, by the deceased, but they can recover it from Susan if she should take the lump sum. And in taxing Michael, they will take his lump sum history into account in the determination of the tax. The second option is to take no lump sum and to take a living annuity. There won't be a lump sum. There will be no tax on the lump sum, and Susan will be taxed on the annuity or the annual drawdowns that she take. In both cases, of course, no estate duty on anything. Take a portion as a lump sum and a balance as a living annuity. In that case, it's a combination of the two. The lump sum taxed in the estate of the deceased, what she continues with in the form of an annuity. If Michael should retire today, he will acquire an income of 630,000 rand for the first year of his retirement. The capital that he will have is 7,789 million. This will consist of 1.2 million in share portfolio and 65189 in living annuities. In other words, we're looking at the living annuity coming out the Provident Fund, we're looking at the existing one, and we take into account the 1.2 million share portfolio. If the full amount is withdrawn from the living annuity is 9.5614. In other words, if he wants that income of 630 as a drawdown in the first year, he must withdraw it from the total value of the living annuities. And I can't now recall, but I must have done that way. The 630,000 as a percentage of the living annuity capital of 6589 is 9.5614, which is within the percentage that he is allowed to withdraw. We just assume that, but of course, there's so many options available here, and we're not going to discuss, and I'm not saying that's the best. Advise Michael as to how he can restructure his capital drawdown in the first year after retirement in order to pay the minimum amount of income tax in that year. Assume that he retires at the end of the tax year and that the 630 will be his only income for the year. This is not a complete answer. It's just a way of me saying to you, think along these lines. And that is that if he needs 630,000 in that first year, he's going to get it from various sources. Now, he's 65. If he's 65, his tax threshold is going to be 75,750. And you can calculate that yourself, or you can take it from your little tax booklet, the one that you must take with you into the exam. In the case of the men, that fits into your shirt pocket. He must withdraw because of the rule. He's got no choice. He has to withdraw 2.5 million of the living annuity capital, and that's 164,725. Then in addition to that, he needs some cash to be invested as an emergency fund, and also to make use of the 23,000 rand of interest, which is tax-free. If that 164 and the 23,800 he is going to get, if he takes the living annuity 2.5% and he takes the interest, then to get to the 630, he needs another income of 441475. Now, I'm not saying he should do this. There's various options, but what he can do, if he withdraws this from the capital of the non-living annuity, this withdrawal will be tax-free. If he withdraws it from the living annuity part of it, then of course it's going to be taxable. But his tax position based on that will be, if he draws it from the tax-free option, and remember, I'm not saying he should, I'm just showing you options. Draw down from the living annuity the 2.5% plus the interest, and then of course, if we calculate the tax with exempt, his tax will only be 16,016. If he takes it from the living annuity, which is probably what he will do, it will of course be different. Then this I'm going to fly through. Do a new monthly cash flow, which takes into account any recommendations that you've made in respect of new financial products that are to be taken out by Michael, as well as any other recommendations that you think should be taken into account and improve the monthly cash flow. Firstly, I've just mentioned the 3-year cash flow. You must repay the housing loan. I'm sure you'll agree with that, and probably the car as well. This is just a cash flow. I just want to show you the changes that I've made to the original one. Obviously, the new income tax calculation that you've done, you include there. If you've recommended a new policy, you include that there. If you have recommended that the housing loan is to be repaid, you take that out. If the monthly installment on the car disappears because you must repay that, you take that out, and then you look again, what is his cash flow now? And if my figures are correct, there's now a surplus. And of course, I would suggest that the surplus then be invested, because that must take the investment place in place of the loan that he had. Right? Erases all drawings. Just quickly, normal pen tip. There we go. And that's the end of the case study, but don't go yet. Somebody asked me, and I'm not so sure that I must even explain or begin to explain that. I was asked at one of the live seminars that they want this formula. In fact, there was just a question from one of the delegates today. What is the formula? Remember, I stated that if a life assurance policy is payable to the estate of, say, a person that's married under the accrual system, then the position is that that policy will be taken into account for the purpose of the accrual claim. Therefore, any new life assurance that is taken out, either to cover debts in the estate or even with the reason of paying the accrual claim, will get similar treatment, will be taken into account in the estate of the deceased person. That, however, will result in, and I'm just going to highlight some of the things. Maybe I should take the spotlight. There's the spotlight. Half the policy, because of the formula, because of the accrual claim, will go to the spouse. The other half, 20% of the other half of P, the policy proceeds, will in fact be dutiable. The portion that goes to the spouse in terms of the accrual claim will be Section 4LA deductible. So we don't take 20% on that. Then we take executors' fees on both halves, and then we take into account that executors' fee. I can't remember what I did there. There's an adjustment for estate duty and for executors' fees. I did this formula 2 years ago. Took me not 5 minutes. I'm not even going to tell you how I struggled with the damn thing. The bottom line is, if a person wants to take out a policy on his own life, married under the accrual system, he wants the policy to be paid to his estate, and he wants a particular amount to remain of that policy for debts or for whatever, then he must look at his cash shortfall in his estate, and that A is for assured amount, in other words, the amount needed. And that cash shortfall must be multiplied by 2.7168. If he needs 100,000 rand to be available in his estate as a result of a policy that he takes out on his life, because of the fact of the estate duty attracted by some, the executor's fees, the fact that half will go to the wife to increase the accrual claim, and the fact take into account that the half that goes to her is not dutiable because it goes via Section 4LA, he must multiply the estate by the shortfall by 2.7168, and if he should do that, what will remain is the amount that he needs. I'm not saying that you should use that in the exam. I'm just saying that that is, in fact, how it works. Right? His drawings, then I'm going over to the last of the slides, and I'm not going to spend a lot of time on that. I think it's the last one, if I remember correctly. 2, in fact. I've done this in the live session when we went around the country, and I told you that the new rule is, as far as the 11F deduction is concerned, contributions to funds, that the deduction is now, as you can see, the lesser of 3 amounts, 350 or 27.5%, or C, the taxable income of the person before the Section 11 deduction and before the exclusion of the taxable capital gain. And the last one is a new introduction. Not normally a train smash. What baffles me is that in paragraph B, the B block in the middle, you can clearly see that they say taxable income of the person before deducting any deductions under Section 11F and 18A. There's no reference to 18A in the C portion, which says to me that they probably mean that it would be after. It'll be an amount before 11F, before the inclusion of taxable capital gain, but after the donation deduction under Section 18A. Now, this year, I'm not going to explain. I've done this on a spreadsheet. Don't please email me to get the spreadsheet from me, because I'll tell you what, when I prepared for this, I went to the spreadsheet, and because I've emailed it to somebody else some time ago, I've locked all of the cells so that one cannot change it. And then last night, when I had to use the example as it was, I wanted to change it, but I couldn't open the thing. I'm not that great with Excel. But what I want to explain to you just here, I'm just going to use the spotlight, is that in this case, the A is 350,000, that's given. B is 27.5% of his taxable income before Section 11F, 18A, and capital gains tax, which is this amount, the 556,200, but after the inclusion of the taxable capital gain, which adds another 400,000 to there's your taxable capital gain, which means that that total of the two, that including taxable capital gain, is 956,200. 27.5% of that becomes to 262. Do you see 955? Then, so those two easy to calculate. Then the other one, the third one, is the taxable income before 11F and before taxable capital gain. I'm not sure whether it should be after or before Section 18A. If we should leave 18A out of it, that 556,200 should be the C amount. However, because of the fact that it does not say, what I did was to continue the calculation. I did some mathematics that I'm not going to explain. I'm not even sure whether it works. Excel did it for me. And what I did is to go right through, calculate the 18A deduction, then get to taxable income, And then I say there's one of two possibilities. This amount here either is the 556,200, or if we really must take the amount after the donations tax has been deducted, what we've got to do is to do exactly that. So what I've done, I took the 556,200, I removed from it the donations tax because I beg your pardon, the section 18A donation deduction, and then that amount is 486,550. But whichever one it is, it's the smallest of the three. In this case, the smallest is 262,955. I think that what you must not break your head about is that last one. Hopefully, it will be a straight choice. If that, by the way, is to say if you do get it into the exam, it'll be a straight choice between A and B, and that they won't move you into a situation where actually things will be different. Erase all drawings. I'll be with it. Just again, normal drawing mode. Okay, and then section 10C. Now, we did discuss that. Go through these 2-3 slides. I don't want to keep you after 4 o'clock. There's no example. I've just given you the so-called rule. Make sure that you know how section 10C works for the examination. Now, the reason why I did that, I wanted to go back to questions that I may have missed. Question 6, if the wife pays the policy proceeds, that I have definitely answered. Do you agree? I've explained how that works. I'll just make sure I've called them all. I've answered Bo's question. Vazana, Eric, I think those guys, don't bombard me now, all of you, with the same question tonight. But those people that have posed these questions, please send them to somebody, and that I get them tonight and answer them. There's one, where will there be estate duty and executors fees on the LA if the LA has no beneficiary? That's the life insurance policy. That one I did not answer. If it's not payable to the estate, quibus, then there will be no executors fees. They will not be, because the executor will not handle it if it's payable to somebody else, but the policy will still be deemed to be property and be dutiable, unless, of course, the beneficiary is a section is the surviving spouse, in which case it will be section 4Q that does all of that work. And then, do we do the tax calc as he is still alive? The question comes after an estate duty calculator. So what do we assume? Do we do the CGT of part of this? Carmen, thanks for the question. I'm not exactly sure what you mean, but I've got a minute and two, I suppose, before they'll cut me off. I don't know if this comes from America, the system, or what they say we should be finished at 4 o'clock. But remember, when it comes to income tax being deductible for the income tax payable by the deceased person, first, the date of his death, in the year of his death, is deductible as a liability. I say possibly. If that person was employed for 10 months of the year and then he died and he paid pay as you earn, he may not be liable for any tax because he's paid more than what he owes SARS is the difference between his liability for that period minus any credit by way of earn and by way of provisional tax. So you can assume that if you've done a tax calculation for this person for the full year, we've done a tax calculation for this person for the full year. The idea is to show how to do a tax calculation. That is not the amount of tax that you can claim as a deduction for estate duty purposes, because he may die on the 1st of March. If he dies today, which is early in the year, he probably would have received one salary and he would have paid pay-as-you-earn on it, so there's no by SARS. So if an examiner wants you to deduct something there, he will have to give it to you. Okay, so I hope that answers the question. And if I can get an indication or have a message that I can start picking up from perhaps from Kirsten, while I'm waiting for that, let me first say to you guys, it was nice trying to help you, and I hope you all do. And thank you for when we went throughout the country, all the hospitality. And good luck, good luck, good luck. I wish you all to do your part. And Kirsten says, I will send the answered questions to you. Thank you very much. So I say to you all, go well, have a nice evening, and I'll speak to you hopefully again in the future. Bye.